Key terms in real estate finance transactions. Navigating the complex real estate finance market. Presentation overview. Overview of real estate finance transactions. Real estate finance transactions involve a variety of key players and typical transactions. This section will provide an overview of these key players and transactions. Time value of money. The time value of money is a crucial concept in real estate finance. This section will delve into the concept and how it applies to real estate finance. Real estate valuation techniques. Real estate valuation techniques include market-based, cost-based, and income-based valuation. This section will explore these techniques in detail. Real estate financial modeling. Real estate financial modeling involves cash flow modeling, sensitivity analysis, and scenario analysis. Real estate finance transactions overview. Types of real estate finance transactions. Real estate finance transactions can take many forms, including mortgage loans, refinancing, commercial real estate transactions, and other complex financial instruments. Key players involved. Real estate finance transactions involve many different players, including lenders, brokers, lawyers, appraisers, and other professionals. Typical transactions. Real estate finance transactions can be simple or complex and may involve property purchase, development, construction, financing, or refinancing. Role of real estate finance in the broader economy. Real estate finance is an important aspect of the broader economy as it helps to facilitate property development and construction, support ownership, and drive economic growth. Time value of money, present value and future value. Present value and future value are fundamental concepts in finance that help us understand how money grows over time and how to calculate its worth at different points in time. Discounting and compounding. Discounting and compounding are two methods used to calculate the present value and future value of money. Discounting is used to calculate the present value of future cash flows, while compounding is used to calculate the future value of present cash flows. Net present value and internal rate of return. Net present value and internal rate of return are two methods used to evaluate the profitability of real estate investments. NPV measures the difference between the present value of cash inflows and the present value of cash outflows, while IRR, internal rate of return, measures the rate at which an investment generates cash flows. Present value and future value. Present value. Present value is the value of a future cash flow or stream of cash flows in today's dollars, taking into account inflation and the time value of money. It is a crucial concept in real estate finance as it is used to determine the current worth of future income streams from real estate investments or mortgage loans. Future value. Future value is the value of an investment at a future date based on its present value and the expected rate of return. It is used to determine how much an investment will be worth at a future date, given its expected growth rate and the length of time until that date. Discounting and compounding. Discounting. Discounting is a process of determining the present value of a future cash flow. It takes into account the time value of money and the risk associated with the investment. Compounding. Compounding is the process of determining the future value of an investment over time. It involves calculating the interest earned on the principal investment and reinvesting that interest to earn more interest in the future. Net present value and internal rate of return. Net present value, NPV. NPV is a financial tool used for evaluating real estate investments. NPV calculates the present value of cash inflows and outflows to determine the value of an investment today. Internal rate of return, IRR. Internal rate of return is another financial tool used for evaluating real estate investments. IRR calculates the rate at which an investment will break even by discounting future cash flows to their present value. Real estate valuation techniques. Market-based valuation. Market-based valuation is an approach to valuing real estate that uses market prices of similar properties to determine the value of a property. This method is useful when there are many comparable properties available for comparison. Cost-based valuation. Cost-based valuation is an approach to valuing real estate that estimates the cost of replacing the property with a similar one. This method is useful when there are no comparable properties available for comparison. Income-based valuation. Income-based valuation is an approach to valuing real estate that estimates the value of a property based on the income it generates. This method is useful when the property is used for rental income. Market-based valuation. Market-based valuation is an approach that uses comparable sales data to estimate the value of a property. This method is widely used in real estate finance to determine the market value of the property. Based valuation. Cost-based valuation is a real estate appraisal method that estimates the value of a property based on the cost to replace it. While this method is straightforward and easy to understand, it may not accurately reflect the true value of a property due to factors such as depreciation and changes in market conditions. Income-based valuation. Income-based valuation is used to estimate the value of a property based on the income it generates. This approach is commonly used in real estate finance due to its accuracy and reliability. Cap rates. Cap rates are commonly used in income-based valuation to determine the rate of return on an investment property. This metric is calculated by dividing the net operating income by the property's value. Gross rent multipliers. Gross rent multipliers are another commonly used metric in income-based valuation. This metric is calculated by dividing the property's price by its gross annual rental income. Discounted cash flow analysis. Discounted cash flow analysis is a more complex method of income-based valuation that takes into account the time value of money. This approach is commonly used to value commercial properties or properties that generate a long-term stream of income. Real estate modeling, real estate cash flow modeling. Real estate cash flow modeling is a vital tool in real estate finance that helps to evaluate the financial feasibility of a real estate project. It is used to forecast future cash flows and determine the profitability of a real estate investment. Sensitivity analysis. Sensitivity analysis is a technique used in real estate financing modeling to evaluate the impact of changes in key assumptions on the financial feasibility of a real estate project. It helps to identify the key drivers of the project's financial performance and determine the level of risk associated with the project. Scenario analysis. Scenario analysis is a technique that helps to evaluate the potential financial impact of different scenarios on a real estate project. It is a useful tool for risk management and helps to identify potential opportunities and threats to the project's financial performance. Real estate cash flow modeling. Real estate cash flow modeling is a technique used to estimate the cash flows generated by a real estate investment over a period of time. It takes into account factors such as the rental income, expenses, and capital costs, and helps in evaluating the profitability of the investment. Uses of real estate cash flow modeling. Real estate cash flow modeling is widely used in real estate finance to evaluate the profitability of real estate investments, forecast future cash flows, and make informed investment decisions. Sensitivity analysis. Sensitivity analysis is a technique used to understand how changes in key variables impact the outcome of a real estate investment. It is important for making informed decisions and minimizing risks. Scenario analysis. Scenario analysis is a useful tool used in real estate finance to understand how different scenarios can impact the outcome of a real estate investment. It involves analyzing different variables such as interest rates, inflation, and vacancy rates to project future cash flows and estimate the risks associated with the investment. Conclusion. Overview of real estate finance transactions. Real estate finance transactions can be complex, but understanding the key terms and concepts is essential for success. Time value of money. The time value of money is a crucial concept in real estate finance that helps investors calculate the present value of future cash flows. Real estate valuation techniques. Real estate valuation techniques are used to determine the fair market value of a property, including the sales comparison approach, income approach, and cost approach. Financial modeling skills in real estate. Proficient financial modeling skills in real estate are necessary for successful real estate finance transactions. Thank you.